Imagine a world where the global economy is on the brink of a significant shift and the stakes are higher than ever. This is the reality we're facing today as stocks firm up on bets of a Federal Reserve rate cut, while gold continues to soar to record heights. But here's where it gets interesting. The markets are sending mixed signals, leaving investors wondering what's next. As we delve into the world of global finance, it's essential to understand the intricacies of the market and how they impact our lives. The recent trends in the stock market have been nothing short of remarkable, with global stocks on track for a weekly gain, despite some European shares slipping 0.1%. The Nasdaq and S&P 500 futures were flat and down 0.1% respectively, after the Wall Street indexes hit new peaks overnight. The MSCI All-Country World Index remained on track for a 1.8% weekly gain, a testament to the market's resilience. But what's driving this trend? The answer lies in the expectations of rapid-fire U.S. rate cuts, which promise to lower borrowing costs globally, providing relief to stressed bond markets and putting pressure on the dollar. And this is the part most people miss. The impact of these rate cuts on the global economy will be far-reaching, affecting everything from job markets to commodity prices. Gold, for instance, is on track for a fourth weekly gain in a row, trading near record levels. As investor concerns about global economic uncertainties persist, the U.S. Consumer Price Report was the last major hurdle to the Federal Reserve cutting interest rates next week. And while it showed an increase in prices, markets remain focused on weak job numbers in the previous week. As Amélie Derembieur, senior multi-asset portfolio manager at Amundi, put it, even if we have some weaker numbers on the job market, the markets are really focusing on the Fed impact that will give a new boost to growth in the future. Veronica Clark, an economist at Citi, echoed this sentiment, saying the bank continues to expect 125 basis points of Fed rate cuts over the next 5 meetings. But here's the controversy. Some experts argue that the Fed's rate cuts may not be enough to stimulate growth, while others believe it's a necessary step to prevent a recession. Futures markets show a 95% chance of a quarter-point cut to 4.0 to 4.25% next week, and a 5% chance of a half-point cut. The yield on benchmark 10-year Treasury notes rose 2.5 bips to 4.035%, having fallen below 4% for the first time since April on Thursday. In currency markets, the dollar index was broadly unchanged at 97.635, while the euro was flat at $1.17305, after the European Central Bank kept rates unchanged and signaled that it was in a good place on policy. But what does this mean for the average investor? The answer is complex, and it's essential to consider multiple perspectives. The ECB's decision to hold rates steady has sparked debate among experts, with some arguing that it's a sign of a strong economy, while others believe it's a missed opportunity to stimulate growth. Greg Fuzesi, an economist at J.P. Morgan, noted that the ECB's statement suggests the Governing Council is not inclined to ease in the absence of a large growth shock. As we move forward, it's crucial to ask, what do you think about the Fed's rate cuts and their impact on the global economy? Do you believe they will stimulate growth, or are they a sign of a larger problem? Share your thoughts in the comments below, and let's continue the conversation. The world of finance is complex, and it's essential to consider multiple perspectives to make informed decisions. As the market continues to evolve, one thing is certain: the stakes are high and the outcome is far from certain. So, stay tuned, and let's navigate this complex landscape together.